Hello, finance lovers. Gold, throughout its astonishing journey from the earliest barter economies of human history to the modern financial world, has always lingered in the background, like a silent witness to the quest for a tangible measure of value. Discrepancies in needs between hunters' furs, fishermen's catches, and farmers' grains, combined with the perishability of goods and divisibility problems, forced communities to seek a more durable and reliable medium of exchange. While the introduction of silver shekels for daily transactions in Mesopotamia around 3000 BCE was an important step, silver's tendency to oxidize and its rapid degradation in purity undermined trust. It was precisely at this point that gold, with its geological rarity, chemical durability, and workability, emerged not merely as a metal but as a potential standard of value. Its resistance to corrosion and the consistent way human eyes perceive its shine across geographies made it a symbol of trust, both economically and culturally. The fact that it was regarded as a symbol of immortality in the treasures of Egyptian pharaohs reinforced this perception. In the 7th century BCE, the standard gold staters minted by Croesus, king of Lydia, guaranteed with approximately 98% purity and a royal stamp, transformed the rules of Mediterranean trade merchants traveling from Ephesus to Persian lands now knew that the coins they carried would be accepted almost everywhere. This value relied not on the word of a king, but on the intrinsic qualities of gold itself. Subsequently, Persian derricks, Macedonian staters, and the conquests of Alexander the Great turned gold into the common currency of the Hellenistic world, the Roman aureus, meanwhile became central to the system in every context, from legionaries' wages to the vast fiscal apparatus of the empire. During the Middle Ages, the Byzantine solidus maintained its purity for centuries, while Europe's feudal fragmentation caused local currencies to lose value rapidly. However, in the 13th century, the Venetian ducat and the Florentine florin re-established international trade on a gold-based foundation. In the 16th century, the massive influx of gold and silver brought from the Americas by the Spanish, especially from the Potosi mines, triggered a price revolution in Europe, and mercantilist states began to regard their gold reserves as a measure of national power. In 1717, Isaac Newton fixed the price of 1 ounce of gold in Britain at £3 17 shillings 10 and 5 pence, laying the foundation for the classical gold standard, which would last for more than 2 centuries. Gold thus assumed the role of the ultimate benchmark of value in the interstate system. The 19th century became the true age of victory for gold. The gold discoveries in California, 1848, Australia, 1851, and Klondike, 1896, increased global supply. Interestingly, this abundance facilitated countries' adoption of a common gold standard. In the 1870s, Germany, France, and the United States abandoned silver and shifted to gold-based monetary systems. By 1914, the entire developed world operated under the gold standard, with each banknote directly redeemable for a specified amount of gold held in central banks. The low inflation period between 1870 and 1914 served as evidence of the price-stabilizing power of the gold standard. However, the enormous financial burden of World War I led many countries to suspend convertibility. In the 1920s, the gold exchange standard, where national currencies were tied not directly to gold but to gold reserves in London and New York, proved short-lived. Britain abandoned the standard in 1931, the United States in 1933. Roosevelt's prohibition of private gold ownership and the subsequent increase of its price to $35 marked the beginning of a new era. After World War II, the Bretton Woods system tied the dollar to gold and other currencies to the dollar, giving gold an indirect but global role as a standard of value. Due to the costs of the Vietnam War and growing U.S. trade deficits, Nixon's closure of the gold window in 1971 ended this system entirely, ushering in the era of fiat currency. Nevertheless, gold has consistently remained a safe haven during crises. After the 2008 global financial crisis, central banks became net buyers of gold once again. Russia and China systematically increased their reserves. While digital assets like Bitcoin claim to be digital gold, they cannot replicate gold's 5,000-year history of never losing its value, its cross-cultural acceptance, or its physical scarcity. Silver oxidizes, paper money erodes, through inflation, and cryptocurrencies rely on electricity and algorithms. Gold, however, meets virtually all criteria required of a reliable measure of value through its chemical durability, resistance to forgery, portability, and inherent scarcity. Ultimately, gold is not merely a metal used throughout history. It is a unique phenomenon born at the intersection of human psychology, geology, chemistry, and economics. Modern states may print as much money as they wish, yet in times of crisis they invariably turn to gold. History has repeatedly affirmed gold as the final arbiter of a value, the ultimate standard of value. Next video. The Tulip Mania, the first financial bubble. We'll explore the story behind history's first financial bubble. Subscribe so you don't miss it.